I would like to talk briefly about the negative tail risk premium anomaly, paper that I've written with my friends and co-authors Arno Polanski and Lynn Nguyen, all three of us based in England. And as the title suggests, this looks at the negative tail risk premium anomaly. Now, standard finance tells us that there should be a positive risk premium. The higher the risk on an asset, the higher the expected return. And the same would be extended to tail risk. So the higher the tail risk, the higher the expected return. That's what standard theory shows. This can be shown formally. Indeed, we do so. But the empirical fact is that higher tail risk does not lead to higher expected return. Indeed, it leads to exactly the opposite. Higher tail risk leads to lower returns. So our objective in this paper is to show exactly which tail risk component drives this anomaly, whether it is the systematic or the idiosyncratic component of tail risk that drives the anomaly. We use expected shortfall as a measure of tail risk because, being a conditional expectation of tail risk, it is very flexible and can be very easily manipulated to give very transparent components of tail risk. So this is the reason, and you'll see briefly what I mean with this measure being transparent, because in high dimension, transparency is very important. If you work with other measures of tail risk, it quickly gets out of hand, they can become intractable. Expected shortfall does not do that. It is transparent, so that allows us to work very flexibly with this. So using expected shortfall, we then can decompose a measure of tail risk into systematic and idiosyncratic components of tail risk, just like we do with standard classic textbook measures of risk, more precisely volatility, that can be decomposed into systematic volatility and idiosyncratic volatility with all the applications that are there in the literature. We do the same with tail risk, and then examine which of these components attracts a risk premium, examine where the anomaly comes from, which of these components drives the anomaly. And we find that idiosyncratic tail risk is the driver of the anomaly, not the systematic component of the anomaly. So this goes completely against theory because standard theory, classic theory says that systematic risk measures are those that attract the risk premium. Idiosyncratic risk is diversified away, so wouldn't attract any risk premium. You would think that the same would apply to tail risk, and it doesn't. Indeed, idiosyncratic tail risk is the driver of the negative risk premium anomaly. Systematic is at best insignificant, so does not attract a risk premium. So this is one of the most important, basically conveys the intuition of the paper, what we mean with decomposing tail risk. So here we've got a very simple two-dimensional partition of tail risk. We've got an asset, a hypothetical asset Ri, and we've got the systematic factor, in this case market factor Rm. We've got, for sake of illustration, a simple single index model representation depicted there by the blue line, the blue diagonal line that captures this single index model. And then we've got two hypothetical tail returns represented by these two black dots. which fall into that shaded area. The shaded area is, how is that defined? Is basically the returns that fall below the value at risk. We're here represented by a quantile. The value at risk of asset I is basically a low threshold, so returns below 20%, something that happens very rarely. And we do that for asset I, and you can do the same for the market. You can define the tail risk of the market as the threshold that is exceeded, is breached only alpha percent of time, very rarely, 5%, 10% of the time, represented here by this vertical dashed line. The area where they overlap, represented here by this gray shaded area, in the literature proxies the systematic tail risk. So when the market experiences an extreme event, so does asset I, that is driven by this systematic relationship between the two. The market is in the tail, drags the asset into the tail, and they end up here. This is used by others, so we simply take that for granted. The only extension we do to this is, if you accept that this is a measure of systematic tail risk, you have to accept that this is a measure of idiosyncratic tail risk. If an asset experiences a tail event, but the market is not in the tails, that must be idiosyncratic tail event. So then we've got these two assets that are represented by these two black dots. This black dot here is a systematic tail event. This is an idiosyncratic tail event. And then you decompose those. So the distance from the horizontal axis to the black dot is the return. And that return can be decomposed as the systematic exposure, represented here from the distance from the horizontal line to the asset pricing equation, represented here by the blue line. And the distance from the blue line to the black dot, that's the idiosyncratic component of tail risk. You do the same for the idiosyncratic return there. You can decompose it into systematic and idiosyncratic, and now you've got pretty much everything you need to perform this exercise. The illustration here is obviously in 2 dimensions. Asset pricing models are, now the literature obviously has moved away from single index models to 3, 4, 5, Fama and French 3-factor, 5-factor models and the like. So this is for illustration. It gets tricky. Obviously, it's impossible to visualize that in high dimensions, but we don't need to. You can formalize that straightforward, as I'll show you very briefly and illustrate it with the graph. So I'm going to have to go back and forth a couple of times here. Why is this important? It's important because a clear decomposition prevents double counting and misclassification of tail events. In the paper, we've got a few examples, well-published papers that try to classify tail events, and that leads to misclassification of tail events. So what they take as a measure of idiosyncratic or systematic tail risk, is not quite accurate. So that is why it is so important to decompose tail risk carefully. Okay, so in 2 dimensions it is straightforward to decompose tail risk. In high dimensions it gets tricky, and I'm not gonna test your patience and sort of detail this, but this is basically what we have. It's the first equation there defines expected shortfall, is basically just a conditional expectation in the tails. Expected returns, the average returns in the tails, the single index model, the tails of asset I, tail of the market, their overlap, and the proportions of the systematic and idiosyncratic components. So these 2 measures here are basically the proportions of the gray area and the green area. And then with this, you're good to go in high dimensions. Indeed, in the paper, we use Fama and French 3-factor model, 5-factor model, and use that to decompose expected shortfall into systematic and idiosyncratic. So these two guys, systematic expected shortfall and idiosyncratic expected shortfall, can in turn be decomposed further, as we show here, into these ugly looking things. But with a little bit of time and patience, you can actually make sense of these guys. Indeed, we interpret them, but in a nutshell, systematic expected shortfall, these guys, the returns that fall in the gray area, can be decomposed into systematic and idiosyncratic. And the same for the returns that fall in the green area. Returns can be decomposed into systematic and idiosyncratic there. So once you have these, then you are ready to use them in a standard regression, Fama-Macbeth sorting frameworks to examine the risk premium that they attract. Okay, so first we have some theory there and show that theoretically expected shortfall and the components, idiosyncratic expected shortfall, systematic expected shortfall, should carry a positive premium. With standard theory that the higher the risk, the higher the return. Otherwise, no rational investor would be attracted to invest in an investment that has high risk and low returns. No rational investor would accept that. So that just extends this intuition. It can be shown straightforward. Out of respect for your time, I'm not gonna show you but it's quite straightforward to formalize that, as we've done in proposition 1 there. However, empirically, we find that total expected shortfall has a negative premium. You run a Fama-Macbeth regression and you find the expected shortfall attracts a negative premium. So this is yet more, and we're not the first to show this, others have shown that, that expected shortfall tail risk, more generally, has a negative risk premium. What we contribute in this regard is to show that this is driven by idiosyncratic expected shortfall. Systematic expected shortfall is insignificant at best of times. So then we have another theory to try to rationalize this finding, and we attempt to do that with investor complacency, which goes, I'm just going to give you the flavor and the intuition of the model, that basically says that investors have a limited supply of resources, including cognitive. The world is flooded with information, so on and so forth. You couldn't possibly process that all. So you limit your attention to what is most important. The most important is systematic news. And you ignore, overlook, generally downweigh idiosyncratic news. So news that is relevant to this firm or that firm, but you are more concerned about systematic news such as GDP, interest rates, tariffs, and the like. Okay? So this means that if you overlook idiosyncratic news, ignore it or downweigh it, whatever term you want to use, then you downweigh idiosyncratic tail risk, and therefore the perceived expected shortfall, the perceived tail risk, is too small. As a result, if you underweight from specific crush risk, you underprice idiosyncratic tails, and therefore you underprice tail risk, expected shortfall. And we formalize this with another proposition that we have there. Okay, so then we take these models to the data and we do the standard, the usual, use the usual data from CRISP, CombiStats. We use the standard filters. We kick out penny stocks, if stocks are not liquid, if they haven't been traded for 15 days or more, and so on and so forth. And we end up with just under 1.8 million stock month observations, so pretty large sample. And here we've done exactly what we've got 2 or 3 papers that we are sort of trying to respond. We followed them to the letter so that we know the Q's, OUR, the subsampling data mining, and so on and so forth, following the same filtering that those guys have done. We estimate expected shortfall non-parametrically for 5% robust to alternative alpha, and use a wide range of controls as is standard in the literature. Okay, so the main explanation offered in the literature so far is that tail risk is underpriced because investors underestimate the persistence of tail risk. Tail risk is persistent, investors underestimate this persistence, so that means pricing continues. And these papers that I mentioned there say that this mispricing, the persistence is underestimated over a horizon 6 to 12 months, so the mispricing also takes a similarly long horizon, 6 to 12 months to be corrected. So the first step is to examine the persistence. Examine the persistence of expected shortfall and the components. So what we mean here, or examine the persistence, is basically look at a stock with high tail risk this month, whether it would have similarly high tail risk the next month or otherwise, and vice versa. If it has a low tail risk this month, would it have similarly low tail risk next month? And these are the persistence matrices for the 4 components of tail risk. And you can see, especially here, so the main diagonal obviously is the probability. So these are the transition probabilities of a stock being in a high or low risk category and staying in that or moving to another risk category. So if you are, for example, in the highest risk category for idiosyncratic tail risk, you have almost 58% chance of staying there the next year. If you are in the lowest, you've got lowest tail risk, idiosyncratic tail risk, you've got just under 51% chance of staying there. If these were random, if persistence didn't have any pricing power, these guys would be around 20%, just random. You stay in one quintile, you're just as likely to move to another. And that, 5 quintiles is 20%. So if they would be random, you'd see these guys around 20%, and you don't see that anywhere. You see for off-diagonal terms, but we are not concerned with those. We are concerned with the main diagonal terms. In particular, if you are a high or low tail risk stock, whether you stay high or low tail risk stock the next period. And the evidence shows that yes, it is the case, but not just for expected shortfall, but also for systematic idiosyncratic. So idiosyncratic tail risk is the most persistent, but so is systematic tail risk. So if systematic tail risk is also persistent, why do investors not misprice that? Not misprice systematic tail risk? We then, as usual, conduct portfolio sort. So you sort these stocks, portfolios according to the tail risk measure, and you find that long-short portfolios earn a negative spread. They should be positive. So if you go long on high risk, high tail risk stocks and go short on low tail risk stocks, the spread should be positive. It is in fact negative, and it is most negative for idiosyncratic tail risk, whereas for expected shortfall is mostly neutral. So whether you go positive, you go long or short on these, on average, you wouldn't make a return. Well, then we conduct the usual Fama-Macbeth regressions with the long controls, and we examine the risk premium of expected shortfall in the components. Expected shortfall, as been observed previously, has a negative risk premium. but that is exclusively driven by idiosyncratic tail risk. Systematic tail risk is at best insignificant. Earlier I mentioned that the literature argues that the mispricing is driven by persistence. This persistence takes time to be corrected, up to 6 to 12 months, and we examine whether this is indeed the case. We find that that is not the case. The mispricing lasts only 1 month and it is corrected after that. And all the mispricing of expected shortfall, it is fully captured by idiosyncratic expected shortfall. The black line here is the risk premium of expected shortfall, and that is almost fully accounted by idiosyncratic expected shortfall. This gray line there. The others hover around 0 and they are insignificant. So that's the first observation. The second observation is that these guys are negative only in the first month and they become insignificant in the second month and they remain insignificant throughout the 12-month period. We find no evidence of long-term persistence mispricing. The term structure, so as I said, then we examine, as I'm sure you know now, that no paper, certainly in asset pricing, is shorter than 80 pages, so the paper has become quite long. We do a number of empirical exercises. One of them is to look at the state dependency. So you look at the premium in calm and turbulent periods of the market, and we find that the mispricing largely centers in calm periods rather than during turbulent periods, completely in line with the theory of complacent investors. When things are good, investors overlook tail risk. When things get bumpy and turbulent, then they start to pay attention and mispricing disappears. We also find that the anomaly, the negative risk premium, is larger for firms without a recent tail event. If a stock has experienced a large tail event recently, there is no mispricing to it. But if it's been in the distant past, that it's got a tendency to be mispriced. The idiosyncratic tail risk has a tendency to be mispriced. So it's the recency of when the tail event has occurred. We conduct a number of robustness exercises and we find that it's not explained by leverage, generic downside risk as opposed to tail risk, small stocks, illiquid stocks, or omitted factor exposure. And we find that systematic crash probability measures are subsumed by the systematic expected shortfall terms, so is not explained by those guys. What are the implications? The implication is that monitoring only total or systematic tail risk is inadequate. It's idiosyncratic tail risk that matters most in the cross-section. Indeed, most of the tail risk is idiosyncratic rather than systematic. The portfolio implication is that portfolios that historically would have tilted more towards firms with low idiosyncratic tail risk would have done a lot better than those with exposure to idiosyncratic tail risk. Remaining questions that are still outstanding. Why is systematic expected shortfall neutrally priced? It should be positively priced. Why does not attract a risk premium? We don't have an answer to that. Extensions, we would like to look at this internationally out of sample, look at sectoral heterogeneity, and also ideally look at some direct attention proxies. So, to sum up, expected shortfall has a negative cross-section premium. Theory predicts it should be positive. The driver, we identify idiosyncratic expected shortfall as the driver of this anomaly. It is stronger, this anomaly is stronger in calm markets, fades after turmoil and after recent large losses. The model, the mechanism that we propose is that this is driven by complacent investors that limit the attention dedicated to idiosyncratic news, to firm-specific news, and focus on systematic news. This leads to downweighing of idiosyncratic tail risk and therefore leads to a short-lived mispricing. And it is not explained by competitive potential stories of this anomaly. Well, thank you very much for your patience. If you have any questions. Well, thank you.
Thank you.
Thank you.